Welcome to the deep dive. Today, we're really digging into something pretty key on the economic calendar.
We are. It's the Federal Reserve's interest rate decision.
Right, and the FOMC press conference that follows, which is set for May 7th, 2025.
And this one feels significant. Our sources actually rate its potential impact quite highly, like an 8 out of 10.
It's an 8 out of 10, wow. So it could really move the needle on global borrowing costs, market sentiment.
Especially with all the, background noise around trade and economic growth right now.
Definitely. Now, we've been looking at some expert analysis that was put together just yesterday, May 6th.
Yeah, so it gives us a really fresh perspective on the economic situation just before the Fed makes its call.
And it's based on forecasting, current data,
Yeah.
trying to map out the likely scenarios.
Exactly. The goal here is to really understand the context, not just report a decision. And, the number of factors the Fed's juggling right now is, well, it's a lot.
No kidding. So, listeners, we're not just going to give you a dry summary.
No. We want to explore the key insights, think about those potential market reactions.
And really help you see the bigger picture here. Now, let's be clear up front. A rate change at this specific meeting, it looks pretty unlikely.
Very unlikely. The futures markets yesterday were pricing in about a 95.9% chance of no change.
Right. But we all know, even when the headline seems set, the devil's in the details, isn't it?
Absolutely. And with a rate change probably off the table, all eyes shift to the Fed chair's communication.
The press conference becomes even more important then.
Precisely. What's the tone? What hints do they drop about the future? That's what you really need to listen for.
Okay, so to understand why that communication is so critical, we need to paint the picture first, the economic backdrop.
Let's start with inflation. Still number one on the Fed's worry list, you could say.
Right, and their preferred measure, core PCE inflation that strips out food and energy, it's still, stubbornly above that 2% target.
It is. The latest figures we have. January 2025 was 2.6% year over year. And then February and March, they averaged around 2.5%. So moving down, but slowly.
Slowly is the word. What's been helping it cool off, even gradually?
Well, a couple of things. Lower energy prices certainly helped for a bit. And we've also seen inflation in core goods, actual physical products, start to ease off.
And wasn't there that tariff thing recently?
Yes. The temporary pause on some tariffs that started back on April 9th.
Right.
That likely provided some sort of immediate short-term relief on prices. But the key word there is temporary.
Right, because that pause won't last forever. And there are still risks pushing inflation up, aren't there?
Exactly. You got those geopolitical tensions, particularly in the Middle East.
Still simmering.
Very much so. And the sanctions on Russian oil.
Sure.
That's kept energy prices pretty volatile since the start of the year, really since January.
So that's a definite upside risk the Fed has to watch.
Absolutely. It's this constant balancing act, isn't it? Domestic factors cooling slightly, global factors threatening to heat things up again.
Okay, so that's inflation. What about the other side of the Fed's mandate, the labor market?
Similar story, in a way. Gradually cooling, but still pretty resilient overall.
Okay.
The April unemployment rate, the latest we have, ticked up just a bit to 4.2%.
So from 4.1% in March, right?
Yes. And job creation, while it's definitely slowed down from the really hot pace in 2024, it's still positive.
People are still getting hired.
Oh, yeah. About 325,000 private sector jobs added just in January and February this year. So, decent numbers.
And what about wages? That was a big concern for inflation earlier.
That seems to have stabilized. Wage growth has moderated, which, eases some of those specific inflation worries tied to labor costs.
Got it. So inflation moderating but sticky, labor market cooling but strong. How does this feed into overall economic growth?
Well, that's where we see more pronounced signs of a slowdown.
Okay.
The estimates for Q1 2025 real GDP, they actually point towards a slight contraction, around 0.4% annualized.
A contraction. Wow. And the forecast for the whole year?
It's also revised down. The projection for full year 2025 growth is now around 1.7%.
Down from 2.3% in 2024. So a noticeable deceleration.
Definitely. And the main reasons, well, it connects back to Fed policy, really.
How so?
Those tighter financial conditions, the result of the rate hikes the Fed already put in place, they're clearly starting to bite, dampening activity.
Makes sense.
And then you layer on top of that all the uncertainty around trade policy. It just makes businesses maybe a bit more cautious.
Right. So a really complex mix for the Fed. sticky inflation, a decent but cooling job market, and slowing growth.
That's the tightrope they're walking right now, which brings us nicely to the policy landscape itself.
Okay, so policy-wise, the Fed's kept the main interest rate, the federal funds rate, in that mid 4% range since what, December 2024?
That's right. Trying to strike that balance we talked about, control inflation without crashing the economy.
And they also made a move related to their balance sheet not too long ago, quantitative tightening, QT.
Yes, exactly. In April, they announced they were going to slow down the pace at which they let Treasury bonds mature and roll off their balance sheet,
Slowing the runoff. Why?
primarily to support market liquidity, make sure the financial plumbing is working smoothly. It signals a more gradual approach to normalizing their massive balance sheet, a subtle shift.
Subtle but important. And they
Okay.
keep saying they're data dependent.
Constantly.
Any recent comments from Fed officials that sort of stick out?
Well, Chair Powell, back on April 16th, he talked about the labor market's resilience, but also specifically as investors will be rapidly adjusting yields. Yields.
Okay. And oil, other commodities.
They're probably going to be much more driven by the geopolitical news and those trade developments we discussed earlier.
Less about the Fed decision directly.
Yeah, the direct impact from a no-change decision is likely pretty limited there. Other factors dominate.
Finally, what about the crypto markets, Bitcoin, etc.?
Likely range-bound trading, maybe?
Okay.
Crypto tends to track broader risk sentiment.
So if the press conference changes how risky investors feel.
Exactly. If Powell sounds unexpectedly hawkish, maybe spooking markets a bit, crypto could dip. If he sounds dovish, maybe it gets a boost. So potential for volatility there too, tied to the overall risk mood.
Okay, so let's pull this all together for you listening. The big picture is, while everyone pretty much expects the Fed to hold interest rates steady on May 7th.
Right, that 95.9% probability.
It's definitely not a meeting to ignore. The real action, the key insights, will come from the Fed's statement, their forward guidance, and especially from Chair Powell's press conference.
Absolutely. What we've talked through today, hopefully, gives you the crucial context, the framework for understanding not just the decision itself, but what it might mean for different markets going forward.
And maybe a final thought for you to chew on as you watch this unfold. What specific words, what signals will you be listening for in that press conference? How might they confirm or maybe even contradict the analysis we've discussed?
Yeah, think about that constant push and pull, inflation numbers, job figures, those global uncertainties. How might they color the Fed's thinking in the next few months?
Because it really does feel like the next few weeks and months will be critical for figuring out me and the Fed's are